Okay. All the orders. Roll call.
Nick Curry,
Here.
Dan Jansen,
Here.
Christine Hoffman, Brandon Marisma,
Here.
Eddie Vergara,
Here.
David Cohill,
Here.
Marvin Dupree,
Here.
John Galarno, John Gostilla,
Here.
Jason Sharp,
Here.
Gaylord Candler,
Here.
Ed Dawson,
Here.
John McDaniel, Dennis Pawlowski, Debbie White.
Here.
Okay. Oath of Office Firefighters Board, Ed Dawson, re-elected 2 more years.
Can you just step up here, please? Raise your right hand. Make it official. I, Ed Dawson,
I, Ed Dawson,
do solemnly swear or affirm
do solemnly swear or affirm
that I will support the Constitution
that I will support the Constitution
and will obey the laws of the United States
and obey the laws of the United States
and of the state of Florida,
and of the state of Florida,
that I will,
that I will,
in all respects,
in all respects,
observe the provisions of the Charter
observe the provisions of the Charter
and ordinance of the City of Jacksonville Beach,
and ordinance of the City of Jackson Beach,
and will faithfully discharge the duties
and will faithfully discharge the duties
of pension trustee of the firefighter retirement system.
say that again.
Of pension trustee
Pension trustee
of the firefighters retirement system.
of the firefighters retirement system.
All right. Just sign this for me.
Yeah, that's.
Okay, it's official. No visitors today. Approval of the minutes. Did we do that by board or roll call?
Just voice vote. Give your first and second, and everyone can say aye.
Per board or all together?
No, all together.
Okay, we have a first,
So move.
second.
Second.
Okay, all in favor?
Aye.
Any opposed? Okay. The new business, Police Officers Board, application for retirement, motion to approve Charles Mark Evans, Police Officer, backdrop, retirement effective July 1st, 2019, separation date, May 13th, 2022, meets service requirements for backdrop retirement, 32 years, 11 months of service.
Second.
So we need a motion, police board.
Motion.
And then-
Second.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Gostilla,
Yes.
Jason Sharp.
Yes.
Okay, and then approve Bradley DeFore, police officer, retirement effective June 1st, 2022, separation date May 31st, 2022, meets age service requirements for duty service retirement, 10 years, no months of service, and over age 55. A motion?
So moved. Second.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Gostilla,
Yes.
Jason Sharp.
Yes.
What is a, for the general board, it says consultants report, is that just leading up to Brandon?
Yeah, it's just
Okay,
the new software.
okay.
Ratchet.
Brandon, fire away. Tell us what happened in the market.
Good afternoon, everybody. We've got a little bit of a roller coaster to talk about, but I'll start with kind of the main part of the report, if you had a chance to look. As you might recall, first quarter of every year, we always include a letter from our CEO and broker. And I'm not going to read the letter to you, but I just want to touch on a few of the highlights that are contained in there. First and foremost is a thank you for the opportunity to serve you. If it isn't for clients like you, we don't have a firm in the first place. I just want to make sure you understand how much we appreciate the opportunity to serve. We finished the year 2021 with about $123 billion in client assets under advisement and 87 employees. As you may recall, the firm is committed to reinvest 100% of the profits back into the business. And so kind of to that end, this year the expectation is the vast majority of that reinvestment will be in 2 areas, really, which has been the same for the last couple of years. It's IT, as well as personnel. As we continue to build out the research area, certainly a number of personnel needs, as well as just continued software development and additional products and services to utilize. And then the last item that's contained in the letter is on the right-hand side. It's the change to the partnership. As you may recall, we are 100% employee-owned, but we're in a program where that ownership is being distributed to a greater number of the employees at the firm. And so this year we added 2 to the partnership. Brian Green and Carrie Richardville were added. And so that brings the total up to, I think, 13 it is now, which is highlighted here in the letter. So again, just wanted to make sure you were aware of that change to the organization, as well as some of those other bits contained in the letter. The second part of that is on the next page, which is just an org chart. Obviously, you guys have seen previously Dan Johnson, maybe you saw him down at FPPTA or a couple of the other members of our firm, but you don't often get to see the depth of the breadth of the team. So all 87 people are listed here. Again, I'm not going to go through this, but again, just wanted to try to give you a little bit of understanding that the depth of the team behind us, because there are a lot of folks that, whether it's in the statement processing and report generation or research ideas covering the different strategies, there are obviously a lot of members of the firm working on your behalf. Any questions on anything that I've covered so far? All right. Well, now I'll jump into the actual normal part of the report. So again, this period that we're looking at, it covers the end of the year. And it has been a little bit of a back and forth market. So what we're looking at here, the market was incredibly strong. The blue bar up at the top, the S&P 500 was up 11% just in the quarter. The Russell 3000, 1000 were up 9 and change. Mid cap was up 6, with the small cap, Russell 2000 up about 2%. International was up roughly about 2%, but emerging markets you can see is negative. And then of course fixed income was essentially flat for the quarter. As you look over the last 12 months, S&P was up almost 29%. So obviously the year 2021 was a very good year to be in equities, but the S&P was actually the best performing part of the market. Both growth and value did worse, and then certainly smaller and mid caps also did worse, along with international. Fixed income was actually negative for the balance of the year because of the rise or the increase in interest rates, which I'll kind of touch on a little bit more in just a second. The next page is actually one that I typically do not include, but I just wanted to drill down just a little bit in the fixed income markets and touch a little bit on quality. So if you look at the top part of the page for the quarter, you can see the U.S. Treasuries were up about 20 basis points, or 0.2%, but high yield was up 0.7%. So the lower quality part of fixed income. Now, we don't invest in high yield, but again, just to give you some perspective as to the parts of the market that were doing better than others. And then if you drop down to the lower part of the page in the bottom right-hand corner, you can see over the last 12 months that was really pronounced. Treasuries were down 2.3%. Mortgages and investment-grade corporates were down about 1%. High yield was up 5%. TIPS, which are Treasury inflation-protected securities, up about 6%, certainly with some of the discussion about inflation. We saw those pop. But again, just kind of wanted to give you a little bit more of a drill down into the fact that lower quality tended to do significantly better within the year over the course of the market. And then if you flip to the next page, which is labeled page number 5, you can see in the bottom right-hand corner, I mentioned interest rates a few minutes ago. If you think back 6 months or 9 months ago, we were really starting to see inflation, starting to hear about CPI numbers. First it was 3%, then it was 4%, 6%. But in the middle part of the year, even toward the latter part, you can see that green, gray, and blue lines. Really, interest rates didn't move a lot, even though we were seeing those inflationary numbers. A lot of the expectations were that that was going to be short-lived, and it was going to kind of immediately go back the other way. Well, now the Fed has started to talk about inflation persisting for a longer period of time. And with that, in this most recent quarter, the yellow line, you can see how it really jumped up, in particular, to the 5-year or left, meaning the short end of the curve. Interestingly, on the longer end of the curve, rates actually came down just a little bit. They didn't rise along with the rest of the market. So I think what you're seeing here is the bond market starting to realize that not only is the Fed going to raise, but they're going to start raising faster than we had thought previously. And just as of 3-4 months ago, consensus was that the Fed would raise 3 times over the course of 2022. I think the average now is closer to 6 or 7 times by the end of the year that the Fed is expected to raise rates because of what we're seeing with inflation and everything else. And so, again, I describe the yield curve as sort of the way the bond market feels about the future. And if you have a positively sloped line, so the very left-hand side is today, and this is 30 years from now. So obviously, it's an upward sloping line, meaning we're expecting growth and better things in the future. But it's not as positively sloped. It's a little flatter than it was before. So, I would characterize that as the bond market saying, well, now that the Fed's going to really start raising rates and doing it quicker, they're going to slow down the economy. And therefore, we're a little less excited about the future. Now, we're still forecasting growth. We're not saying at this point that they're going to completely derail the economy, but that excess or that growth needs to be scaled back a little bit. So again, just kind of wanted to give you a little bit of that perspective there.
Raising 6 or 7 times over the course of a year, what's the spread on that? How far do you think it?
Well, that's the real question. If they go quarter points, you're really only talking about 1 3/4. We're starting essentially at 0. So if you think over a 30-year or 40-year window, if they raise 7 times and we finish the year at 1 3/4 or 2%, that still is a very low historical interest rate. So that by itself, I don't think is really a huge concern. It's just that, when you're going through that process of the Fed raising, the markets don't know how much they're going to do and how fast. And so they're, a little bit, cautious.
I think I heard in a press release that they're expected to raise the rates between 1.5% in March, and then the next one would be in June, supposedly. Now, I don't know how true that is, but of course, we can only speculate. 6 to 7 times seems a little excessive. I would anticipate 4 times at least. But
Well, and the question becomes, are 2 or 3 of those moves 0.5%?
right.
And then you actually only move rates 3 or 4 times. But if every one is just going to be 1/4 point, maybe then they do 7 or, and again,
Sure.
that is always, it's a wait and see.
Right.
So if they move 2 or 3 times through the summer and inflation is accelerating, well, they're going to have to modify that schedule. If all of a sudden they see prices really come off and instead of, 5s and 6s and 7s, we're seeing 2s and 3s, then they might back off that schedule.
Right.
But again, the market is trying to guess based on the information that's out today, what that schedule will look like.
Sure.
It of course will change. The next page, again, just tracks the assets of the plan relative to the red line, which is the assumed rate of return, and obviously you can see a very nice excess. I actually realized that this graph doesn't actually completely scale out to the most recent quarter, because we're at $123 million. But interestingly, I reran the assets as of this morning, and as you know, in the current period, the market has been down. We're effectively right back at that $117 million level that you see on that graph. But again, still well above that assumed rate of return. And again, we've talked about this in the past, but excellent to see the plan continuing to grow when you're in that negative cash flow position. Next couple of pages, slice and dice the asset allocation. I wanted to touch on page number 8 because that really focuses on the deviation from our targets. And what you'll notice, as of the end of the year, we were slightly above that 65% equity threshold, with the 4.6% over in domestic equity and 1% in international. Again, we were about 0.6 ahead of that maximum 65. But with the market pulling back here the last few weeks, the market corrected that for us. It didn't really give us the opportunity to come in and have to rebalance again. So we are now underneath that threshold as we sit here today. As we get into the performance, you can see top line, we were behind for the quarter, 4.18%, placing in the 52nd percentile, behind by a full 1%. Notice the benchmark, though, was in the 16th percentile, so ranking pretty highly within that peer group. For the last 12 months, 12.5% versus 13.4, and placing in the 63rd percentile. Over the longer periods, 3, 5, and 7 year, you can see you're nicely ahead of the benchmark, at least for the 3 and 5, and ranking in the top 15 or 17 within the peer group. So again, relative to public funds around the country, the plan is still doing incredibly well over a long period of time. As you move down the page, if you haven't already seen, there is really one glaring spot where the underperformance came from. So obviously the first fund is our Vanguard Total Stock. That's an index fund that exactly what it's supposed to. The next is Wells, or changing their name to Allspring. They were at 1.48% for the quarter, but the benchmark was 11.6%. So a huge deficit relative to the benchmark. One of the things that we saw within the quarter, it's actually interesting, one of the graphs that I often include in sort of this summary presentation, I didn't include this week or this time, but it looks at growth and value in the different parts of the market. So growth was the better performer in large cap this quarter, earning over about 11%. But in mid cap, it underperformed value by 6% at 2.8, and in the small cap, it was at 0, underperforming value by about 4.4%. So interestingly, growth outperformed in the large cap space, but it was really only due to about 5 stocks. Some of the biggest names within the index that are 10, 11, 12% of the growth index did incredibly well and drove virtually all of the returns. So when you have an active manager like Allspring, who often have limitations, they can only own 5%, 6% of your portfolio in any one name. So if they own 3 or 4 compared to an index that owns 11, and that stock goes up 30% a quarter, they're going to have a huge deficit. So that is something that we really saw within the quarter. The actual best performance that I've seen from about 6 or 7 other growth managers is 6% in growth. So another way to say they're not alone on an island here underperforming. This was somewhat of a common theme within the quarter. And also kind of to that end, you can see that 11.6 for the benchmark was in the 24th percentile. So again, well in the upper half. So all that to say, we don't see an immediate problem with Wells' portfolio. Nothing changed dramatically or anything. It's the market really moving around, so that concentration is really what drove those results. Any questions on that? Okay. So kind of moving on, really the rest of the report on balance is really excellent. JP Morgan, your value manager, beat the benchmark by about 1%. And is outperforming for the year. Eaton Vance, or Atlanta Capital, as you recall, they've been struggling for the last few quarters. They had a wonderful quarter. They were up 9.75 versus 3.8, and now for the last year, 22.3 versus 18. But if you looked at that number just last quarter, they were well behind the benchmark on the trailing 12 months. Obviously had a really nice snapback return there. Then the next page, we get into our international funds. Euro Pacific was down 1.1 versus the benchmark of 188. And now for the year, they're behind 2.8 versus 8.2. But again, longer term has been a fantastic manager, well ahead of the benchmark. Again, some of their emerging market exposure certainly impacted the results in the quarter. And then WCM had a very good quarter, up 5.6 versus about 1.8, and well ahead for the year, 17 versus about 8.3. Sawgrass Fixed Income. Before I touch on the results, I did want to, if any of you hadn't heard yet, there was an announcement that they made late yesterday afternoon that Greg Gosh, who's one of their, or was one of their client service and sales personnel, decided to leave the firm. And so from our perspective, again, he had no responsibilities related to investment management or the portfolio itself. So no concerns as it relates to the strategy or the ongoing nature of the firm, but did want to just make sure that you're aware of that departure as you might hear about it if you hadn't already. As for the portfolio itself, it was down about 6 basis points versus the benchmark, which was positive 9. And for the year, essentially in line, down 183 versus the benchmark of 185. Longer term has outperformed nicely, essentially in line over the last year.
Brendan, you see, we all know Greg was recent, but there's been several others. Sawgrass leaving, and you see over the last year is where the issues start. Last year's when the movement started happening last January. Is there any correlation to that, or is somebody to truly look out for?
Not at this point. Really what you've seen in terms of the departures is primarily folks in the sales side or the client service side. And oftentimes they get compensated based on new assets. And Sawgrass, you have the fixed income portfolio here, but they also have a number of equity portfolios.
Right.
The equity portfolios on a relative basis have not done well for quite a while. And I think this is really more of a symptom of that. That tends to be where those kind of sales-oriented people would generate that those sales and that income, and they've just really struggled on that particular side. Again, but the fixed income team has been stable. Overall, we see the firm is stable, but I really think you're just kind of seeing the symptom of that long-term stretch of underperformance on the equity side.
Would you call that abnormal attrition? Or
I mean, you never like to see it, and it always varies, but it's not a huge surprise. Let's put it that way. Again, just sort of given where they are now. Interestingly, just as an aside, I heard yesterday that the equity portfolio outperformed by 2 or 3% just in the most recent period. So sometimes it's funny. You see that whether it's a board terminating a manager that's underperformed for a while, or in this case, maybe somebody moving on to what they think are greener pastures. It's right at the time that maybe things turn around.
right.
Obviously, only time will tell. But
When, for Sawgrass, I see a lot of performance, but I don't see anything talking about duration. How is their duration compared to the index?
I'm trying to think if we include that report in your big book. They don't take a dramatic amount of kind of duration risk. They stay relatively tight to the portfolio. Sorry, it's relatively speaking. They take relatively tight to the benchmark.
The ag is what, like 6 years, so.
Yeah, and moving. I mean, obviously, as interest rates move, it moves around. But something like 6.5 years or something like that. And that's actually something that I was going to mention to the group here, especially since our discussion last time really limited us to some of the more conventional alternatives. In a rising interest rate environment, some of the things that we could do, potentially shortening duration, or looking at some other things like TIPS, or even something like publicly traded like bank loans, or something that within our ordinance we could look at, and if there's interest at the board, we could maybe queue that up for either the next agenda or the next time after that, when there's room to potentially
When
have.
you say bank loans, like floating rate?
Correct. Okay, again, publicly traded, not on the private side. Some of these LP vehicles that our ordinance doesn't allow, but some of those more common public securities. But a way to try to take some of the pressure off of a longer duration core portfolio. As you move down the page, you get into our PIMCO diversified fund. That was actually up 12 basis points versus the benchmark of -70. And for the year, not a huge return, 42 basis points, but the benchmark was down 4.5. So on a relative basis, that fund did very, very nicely. And then the last piece is JP Morgan Real Estate, 8.1 versus 7.7 for the quarter. For the year, about 21%, a little bit behind the benchmark, but still an outstanding overall return. Again, as a private investment, there's a little bit of a delay in how they get valued. So if you remember, COVID hit and really affected equities in the early part of 2020. It wasn't until the end of 2020 into the early part of 21 that we started to really see the negative numbers on real estate based on what was happening in the earlier part of the year. Now, the equity markets roared back in later 20 through 2021, and it took kind of to the end of the year for really for the real estate returns to kind of catch up. And so that's what you're seeing in that 8% quarter. Certainly, all of that didn't happen just in that 3-month period, but you're seeing that continued improvement, in particular in kind of the industrial and residential parts of the real estate market, and certainly fantastic performance. What I would caution you though, that's likely to subside and kind of normalize here. We'd expect more in that 8 to 10% range this year, as opposed to that 21% that we received last year. Any questions or any additional questions on anything in the report specific to the plan? I guess before I move on to this chart, I will just mention, I mentioned the number earlier, 117 million, 116 and change. That does translate to roughly 6% down from the end of the year. Now, if you have to adjust that a little bit for cash flow, so it's probably somewhere in the 5.5% range. So now on a fiscal year-to-date basis, call it 4.5 months in, we're down roughly 0.5%. So certainly not ideal, but what I would say is if you think back over the last 3 years, our equity portfolio has annualized at 24% each of the last 3 years. And here in the face of now the Fed saying they're going to start raising rates very soon, some geopolitical issues, concerns over Ukraine and China, it's not all that surprising for the market to take a 10 or 15% breather. Again, in the grand scheme of things, not a huge concern, but certainly not ideal for the current fiscal year. The last item that I included in your chart is not plan specific. You've seen this before. This chart color codes each of the major asset classes and assigns a specific color and then ranks them from best to worst performer in each individual calendar year. So 2021 is on the far right-hand side, and you can see that dark blue S&P 500 was the best performer. As I kind of mentioned earlier, it's sort of an unusual thing. Over the last 15 years, the S&P's only been the best one other time. And if you think about it, it makes sense because the S&P is a blend of growth and value. And typically, one of those is doing better than the other. And so, its growth is better one year, value is better than the other. And the S&P will tend to be somewhere in the middle part of that graph. But this last year, it actually was the best performer. The joke I always say is, after the meeting or before the meeting ends, everybody needs to tell Dustin what's going to be the best performer at the end of this year. So then when we meet next time this year, we can all review what you said and see who was right. But again, just thought you'd find that interesting. It's a nice little update. But the short version is this is why you diversify. This is why you have real estate, fixed income, growth, value, because you never know what's going to be the best or the worst in any given year. So we want to make sure we have a reasonable allocation to a good number of asset classes to give us that risk reduction, while at the same time allowing us to meet our actuarial objectives. There are no other questions. That is everything that I had for you today.
Thank you, Brennan. Do we vote to approve by board?
Yes, roll call vote for each board. So I get a motion from each board and then I'll call the
Okay.
names.
For the firefighters, motion to approve.
Motion to approve the report.
Second. Second.
Gaylord Cameron,
Yes.
Ed Dawson,
Yes.
Debbie White,
Yes.
All right, general board, motion to approve.
Motion.
Second.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Brandon Maresma,
Yes.
Eddie Pagara.
Yes. Police officers board, motion to.
Motion. Second.
David Cohill,
Yes.
Marvin Dupree,
Yes.
John Costello,
Yes.
Jason Sharp.
Yes.
Okay, and Dustin with the administrative report.
Alright. We did have
a little bit of movement this past quarter in the general employees plan. A couple people that are no longer vested because they retired. So you see the vested number go down a little bit, and then which would lead you to expect that the total number of retirees would go up. But we did have a few people pass away as well, so that number went down as well. But that's really the main part of the movement that we saw. We did just see that we just approved a couple of police officers' retirement there. So we got Commander Evans. Just wanted to mention, he has almost 33 years of service. He couldn't make it that extra month. He has to go on vacation or something.
Yeah, I got 3-month cruise.
Yeah. So he's, that's just a substantial amount of service there. I just want to mention that. I think he's been working for the city since he was 18 years old. So. And we also have, I noted this year, right now, before we had this meeting, we have 10 current employees that have over 30 years of service, which seems like quite a bit. And I know I've got no less than 10 people on my docket that are going to be retiring within the next year, which is a pretty good amount. Kind of spread all over the city, not really targeting any certain area or anything like that, but just notable, I think, and several of those are in the backdrop. So I do think before the year is out, you'll see a higher number coming out of the backdrop than you have in years past, and which will affect Eddie and accounting and cash flow. So some of that cash that we have sitting out will be drawn out for these larger backdrop payments. Normally at this meeting we would do the 5th member selections, but the city this year has changed the way they do the interviews, and they changed the questions and everything. I actually helped them write the questions for pension specific interviews as opposed to just the interviews that they had generally asked people that were applying to every board, the planning commission and all these type things. But the reason we're not doing those elections at this meeting today is because some of those positions, the council has more restrictions on the people that they can select, because they can only select residents. And so if I brought those people up for choice here, you may choose somebody who's a resident, and then that leaves them with fewer choices, which we really don't have that big pool of people who are wanting to be on the pension boards. So I was just asked to hold off, and we'll do a special meeting after the council does their selections. So I don't see any problem with that, but so we'll just have to, before I'll get in contact with you guys, closer to after the council does their elections, and then we'll set up some time to do a special meeting before March 31st, and that'll just be police and fire. FPPTA is having the normal summer conference. It's June 26th to the 29th at the Hilton Bonnet Creek in Orlando. So if anybody's interested in that, let me know about that, because if you wait till the May meeting to let me know, they may already be booked up for that. So if you're interested, let me know. As soon as registration kicks open, I'll be sure and get you signed up. I usually, as soon as registration opens up, I reserve 6 or 7, 8 spots, and then cancel if we don't have enough. But FPPTA has kind of changed their cancellation policy, because I think they had so many people canceling with COVID going up and down, so they actually charge you now. So I'm trying not to just register blank names now for that. But, holiday contribution, I'll just read this. The Sugarman Susskind, Braswell, and Guerrero, I got used to saying that. I added those names to the company there. They did send each board a nice holiday card. said, in celebration of the holiday season, Sugarman Susskind Braswell and Herrera has made a donation in your honor to the Dr. Marilyn Susskind Gynecologic Oncology Research Fund at the University of Miami's Sylvester Comprehensive Cancer Center. The research fund was established and funded before her death by our partner Bob Sugarman's late wife, Dr. Marilyn Susskind, to prevent and cure ovarian cancer, the disease that took her life in 2019. So just want to make sure that I relayed that to you guys, since they did take the time out to make that donation and send us cards. Software update. A couple years ago, we had decided that we were going to get a pension administration software so that the employees could run their own numbers, basically. Instead of having to go through me, they could, this is somewhere where we would be updating it constantly with the payroll information so that they could go on and say, hey, what happens if I retired on this date? What is my normal retirement date? What happens if I retired then? What happens with my projections if I went out, 3 years further than that? What does background look like? They could do all of that themselves with this software. And then we put it on pause once the city was doing their ERP system, and they were kind of like, hey, let's put a pause on all software and regroup and see what this consultant says about the ERP system and every software that we have. So what has basically come back from that is that the city believes that they should be the one to pay for, and the consultant believes they should be the one, the city should be the one to pay for the software, not the pension plans, because the people who are utilizing the software are current employees of the city and not really the pension people, after they start retirement. So soon I will be doing a bid. I'm taking bids in right now and getting quotes, updated quotes from what I got a couple years ago to eventually take to council. I don't know which one it's going to be. I am having a little bit of trouble getting people to give me quotes on this. I've got 2, and I've had several companies turn me down on giving a 3rd quote because they say, we just don't give quotes on organizations your size. We only do cities, the size of Miami and those type things, and just saying it would be in the millions of dollars. That's not something we're prepared to take on. So, but the 2 other candidates that we do have are very good, and I think meet all the needs that we are requesting out of this. It's more than just people running their own projections. It's keeping up with the accumulated contributions calculation, giving that automatic interest rate, and as well as providing the forms people would need for retirement and lots of other capabilities. And both of these softwares provide those type of services. So, any questions on any of that? Any comments?
So we still send people to you if they need numbers?
Yes. Okay. Currently, and I don't want to be out of the loop. I still would like to, let people know their options. That's one thing I'm kind of leery about this software is somebody, they just run their own numbers and then they get to the end and then making a decision that they may not have known they had another option or may not fully understand backdrop or something like that. So I still think I would like to speak with people, but especially for people that are 10 years out who just have no idea what their numbers are going to look like and may never take the time to talk to us, but they would get on our website, punch it in and see, much like you can do it on the IRS to see your Social Security numbers and stuff like that. And then our next meeting is, of course, going to be our big meeting in May. That's why it's at 2 o'clock. I need to look at it, because I think I wrote down the wrong date. With my calendar real quick here, because it's on a Wednesday, not a Tuesday. Wednesday's the 11th. That's not true. It is Tuesday. It's the August meeting that's on the Wednesday because of budget meetings. So it is Tuesday, May 10th, 2 o'clock. I have it at 2 instead of 3. That'll be a lot of what I'm doing in the next, between now and then, is preparing for that, as well as submitting reports to the state for our actuarial report and everything that's coming up. Oh, I didn't bring the letter down with me, but there was an issue with the city of Jacksonville not contributing the Chapter 175 monies. So we got a letter from Gabriel Smith yesterday afternoon that we are submitting to the city of Jacksonville. It was, whenever we had the interlocal agreement a few years ago, it was decided that they would take the Chapter 175 monies and submit it to the plan to offset their contribution. They didn't do that. They did it the first year, and they didn't the second year, and they haven't so far this year. So Gabriel Smith has said, well, here's the amount you're in shortfall for those, and it'll be reflected in the reports and things that Gabriel Smith has given us each year for the actuarial report. City of Jacksonville Beach did make their required contribution, which is significantly more. I mean, we're in the 700 and something, it's like 763,000, something like that. The city of Jacksonville Beach is contributing 10 years, same amount every year, because we looked at what the net pension liability was whenever the firefighters went to the city of Jacksonville. Said, okay, we're going to pay that off over 10 years, and whatever actuarially that Gabriel Smith decides is what the city of Jacksonville will be responsible for, minus the offset, Chapter 175 monies. And that didn't happen. So we just got to get that corrected. I'm sure they will make that contribution soon. But it's being handled.
So this is the second year running that they haven't done.
What's that?
This is the second year running that they haven't done.
Well, fiscal year 2022, now that we're in, would be the second year.
Right.
Fiscal year 2021 is what we're creating the reports for, and everything right now is be the first year that we're seeing the numbers that they did make that contribution. But yes. But I think that's everything for me.
Okay, I think we're ready for adjournment. Unless, anything else? All right, motion to adjourn, somebody?
So moved.